Clock in, put in your 40 hours, and do everything you were taught to do. But participating in the modern economy often feels like playing a game where the rules ensure the house always wins. We are told that hard work equals financial success, yet the reality for most people is a rising cost of living that constantly eats away at stagnant purchasing power. This struggle is the result of a system where the growth of assets has simply outpaced the growth of wages. You are operating within an economic architecture built on rules that no longer reward labor the way they once did. For decades after World War II, the American economy ran on a balanced equation. As workers generated more value, their compensation grew in lockstep. If a factory produced more, the people on the floor took home a proportional pay increase. But the data reveals exactly when that equation broke. Look at the year 1973. From that point forward, overall economic productivity continued to surge upward by over 72%. But real hourly compensation for the average worker essentially flatlined, rising less than 9% over the next 40 years. This massive, expanding wedge between the two lines represents a historic transfer of wealth. The value generated by your extra effort is no longer reaching your paycheck. It's being captured by the owners of the machines and capital. The meritocracy myth suggests that if you aren't getting ahead, you simply aren't trying hard enough. But this data proves that diligence alone is no longer enough to build wealth. To see why your paycheck is losing ground, we have to look at a core tension of modern capitalism. French economist Thomas Piketty summarized it with a specific relationship. R is greater than G. In this model, G stands for overall economic growth, which includes your wage income. This is a linear engine. It is slow and additive because it is strictly limited by the number of hours you can physically work in a day. The R stands for the rate of return on capital, assets like stocks, property, and business equity. This engine multiplies on its own, detached from human labor, and it consistently grows faster than the broader economy. Because the return on capital outpaces the growth of regular wages, wealth concentrates at the top. This creates a thick tail in the distribution, where a tiny minority controls a vast majority of the resources simply because their assets grow faster than your salary. If you rely entirely on wages, you are competing against an engine that never sleeps and never gets tired. You will eventually be outpaced by those who own the assets. There is a second mechanism eroding the value of your labor, and it involves how new money enters the economy. The Cantillon Effect explains that when the government creates new money, it doesn't reach everyone at the same time. Its impact is determined by where it enters the system. New money enters at the top, typically through banks and major investors. These first receivers have an opportunity to spend that money on assets like real estate and stocks before the market has a chance to raise prices. By the time that money trickles down to your paycheck, the cost of living has already surged. You are receiving your raise and currency that has already lost its value to the inflation caused by the people at the top. This time delay acts as a hidden tax on your purchasing power. It effectively subsidizes the investments of asset owners at the expense of those who live paycheck to paycheck. Inflation penalizes those who trade time for money, while it actively protects and grows the wealth of those who already own assets. When these forces operate together over decades, they create a self-perpetuating cycle. The financial markets become a place where existing advantages are used to harvest even more resources. This is known as the Matthew effect, or cumulative advantage. It is a social spiral where initial wealth acts as a resource that produces further gains, making it harder for anyone starting from zero to ever catch up. This dynamic is mapped by the Great Gatsby curve. With high income inequality, intergenerational mobility disappears. Your success becomes determined by your parents' income, creating a closed feedback loop. Winners accelerate upward, while structural barriers at the bottom become increasingly difficult to overcome. In this environment, the economy stops functioning as a ladder and begins to look more like a fortress built to defend existing capital. The reality is that you cannot outwork a system designed to devalue your labor. Hard work is still necessary. It is the only way to generate your first block of capital. But you must stop seeing your daily labor as the final destination for your wealth. Your goal must be crossing over from the linear engine of wages to the exponential engine of assets. This means converting your paychecks into equities, property, or business ownership as quickly as possible. The data shows that labor builds a living, but ownership builds wealth. To secure your future in this system, you must eventually move from trading your time to owning the assets that